Hello option traders, this is Jeff and welcome to part 3 of the daily straddle using the underlying Apple. In this video I plan to cover the rules that I use for a almost 3-month back test on the on-demand application, actually initiating real live orders. Granted, it's a back test, and closing them and opening them and closing them just like you normally would do in rapid succession, obviously. And in this video we'll cover the rules, we'll look at the results over that 3-month period, and we'll look at the chart and sort of figure, what's a good day and what's a bad day for the trade. And I might actually get to doing some adjustments to the rules or tweaking the rules a little bit if you so desire, and how you could do that. But that may end up in video number 4 on the subject. So let's get right to it. Now the rules. Rule number 1. Each normal trading day, buy to open a weekly at the money straddle at the market open. Now, at the money, well, the stock is not going to cooperate and be at the money every day. So what you're going to have to do is, if it's between strikes, and Apple, as an example, has a $5 spread between the strikes. So if it's at the 250 mark, you're going to have to decide whether you want to go at the next strike up or the next strike down. I think everybody can kind of understand that, but let's just go take a look anyway, briefly. Let's see, Analyze tab. Alright, so what I mean here, like for the one that I have on today, I'm at the 620, and it's not doing very good because the stock has only moved 79 cents. Hoping for a gap overnight, possibly. When we cover the rules, we'll talk about that, and when we look at the results, we'll talk about that. But right now, it's not real pretty. So what I mean is, if, for instance, here the price of the stock was at 622.50 when the market opened this morning for this particular strike here, you would have to decide, whether you wanted to go above that or below it, either the 625 or the 620. Now, if you feel the stock is going to move in a particular direction, and that is the scenario that you're opening this up under, you would want to pick a strike in the other direction. For instance, if it was at 622.50 between these two strikes and it looks like it wanted to move down, then you would want to pick the 625, because then it will move into a profitable situation quicker if it's going to move down. Conversely, if it's going to move up, you would want to pick the 620. The 620 strike. I think you get the picture, and if you don't, I guess just drop me a line and I'll help you try to figure it out. Help to clarify it a little bit. Alright, so back to the rules. Second rule, related to the first, if it's Monday, Tuesday, or Wednesday, use the current week's expiration. If it's Thursday or Friday, then you would use the next week's expiration. And on Thursday morning, when the new options for the following week are listed for the weeklies, it may take a while for those to get off the launch pad, so to speak. So it may not be you may not be able to get into it, like right at the open. It may be 5 or 10 minutes after the market opens when they start getting a little bit more liquid and more fluid. So I think that one's pretty plain. The reason for that is, if you pick the current week and the stock doesn't move, and it's a Thursday and you're picking the next day's expiration, the stock doesn't move, time decay, because it's so close to expiration, is going to kill you. So you'll want to pick the next week, which will be a little bit more steady and won't decay quite as quickly. All right, so after you've got it open now, at 11:30, you would go and take a look to see how you're doing. If you have $100 plus in profit, then you would close the straddle. If not, then hang on to it. Go take a break, go for lunch, whatever you want to do. At 3:30, come back. Take a look at it again. If you're at $100 plus profit again, you would sell and close the straddle. If not, then you would hold overnight and sell to close at the open the following day. However, there's one little modification to that rule. Do not hold overnight Fridays or holidays. So for example, if you were to hold overnight on a Friday, you have Saturday and Sunday of time decay. That's going to really, really hurt, and the stock would have to gap considerably in order for you to even get close to breaking even. And if it's like a 3-day weekend with a holiday, or if it's just a holiday in the middle of the week, you don't want to hold the night before that either. So you want to get out at the end of the day if the next day is a Saturday or a holiday. Next rule, do not buy a straddle within the week of earnings, with an expiration that's in the week of earnings. And we all know what that means. First of all, your straddle is going to cost a fortune, because the old market maker move, and in the case of Apple, it could be $20. So the stock's going to have to move $20 just to make a penny. So you don't want to mess around with it the week of expiration. Sometimes it doesn't reach that market maker move too, and on the next day after earnings, you could get burnt pretty good too. But mostly because they're going to cost a fortune. And I went back and I checked, and you're talking like $30 for a straddle, which is a lot of money to pay for one straddle, just to make a buck or two. And then the last rule, no straddle should be held open longer than 24 hours. Now, these are the rules that I use for my 3 months of back testing. And I used them faithfully, except I think I found when I was going through a review that maybe I messed up on one of them. But it didn't mess up in my favor, because I ended up losing money. So worst case, these results may have been better because of that one time that I didn't work within my rules. So here's the results. May, $2,577 profit. June, minus $594 loss. And then July, because I only tested it up to the week before Apple's earnings announcement, made $1,090 for a grand total. And this isn't too bad. I mean, you have to admit, a grand total of $3,073 over an almost 3-month period. That's not bad, right? Not bad at all. So what I wanted to do was just go through some of the documentation that I have. If you notice down here on this spreadsheet, I have the May results exported from Thinkorswim. Remember, I was in the on-demand mode. And I have the June results here. All of them are here. And the 3 weeks in July. It was approximately 3 weeks in July that I ran this test. All right, so let's take a look and see how the profit looks in comparison to the actual chart. I think what I want to do is I'm just going to hide these columns here, because all we care about is the date and the money, right? I mean, that's what we care about, money. Otherwise we wouldn't be here. Okay, Apple's chart. This green block here is the tests that are on this tab for May. Now we start at the bottom with May 3rd, which is this candle right here. So that day we actually entered at 9:33, and we held overnight because we didn't get enough. We didn't hit our $100 mark anytime during this day. We held it overnight and we exited the next morning. Here's the gap that we got. So what, and I don't know exactly what happened that day, but let's say we entered around here at this price level, which would be around 591. And when the end of the day came, we didn't hit our $100, but the next day it gapped down at the open, say around 578 maybe, somewhere around there, and we took our $185 profit. I like that one. All right, and similar situations for the rest of these days. 512, the very next day, that day that we exited one here in the morning, we entered another one around there, and we exited at 11:30. Somewhere in this bar here is where we exited. For all I know, it may have dropped down here, pulled back up, and then went back down again without looking at a daily, and I guess we could do that, but without, and we will actually be doing that on the next video, because I'm going to go back into, hop in the old time machine and go into the past and show you how you can put some limit, and you could put stop limit orders in also, if you want to do it that way. All right, the next day, and that was a $199 day, so that was those 2 days. Actually, 5/4 was a very profitable day, and that was a Friday. And then I remember we exited at lunch, but we would have at this 11:31 time, but we would have exited at 3:30 in the afternoon, or a half hour before the market closes anyway. So then Monday comes along, and we get in at 9:30 in the morning, and we're out at 11:30. We hit our, our rule says we get out, we got $104. I don't have transaction costs in here, but you can figure pretty much that for me anyway, it's about $2.50 for each one of these trades, because I pay on a per contract basis. Just because I think I'm grandfathered from the original Thinkorswim before they got bought out by TD Ameritrade. So that was 5/7, which is right here. 5/7, and then the next day, 5/8. You can see we entered at 9:31. This is 5/8, and you can see that it closed very close to its open, but we have this huge range here. And apparently that's probably how we ended up making money on this particular trade. So much, anyway. The next day is 5/9. And we got out at the end of the day. And the reason why was actually, when I looked at it, it was, well, I should have held this one overnight, so that was where my rule violation was that I mentioned before. So this is 5/9. It wouldn't have been, well, maybe. I'm sure that date's correct. The next day it actually gapped up and then came back down. So I don't know if it would have made anything there or not. I'm not sure. I didn't mess with any of these dates. This is a strict raw download from Thinkorswim. Then on 5/10, which is here, there wasn't enough range in that day to make any money, but you'll notice that I held it overnight, and on the 11th, which was that we entered, let me just show this to you again. We entered about here, held it overnight, and exited at this level. So that allowed the $132. And we jumped right back in again the next day, or that same day, the 11th, and we got out at 11:30 for $257, and that's probably this big wick on this candle here. Probably went up in the morning and then dropped back down in the afternoon. Losing day here, the 14th, which is Monday. That would be this day right here. I'm not going to go through every one of these things, don't worry. I just wanted you to get the hang of, when you look at the candles and the ranges of them, which ones are good ones and which ones aren't. So on the 14th, and we held that one overnight, so we would have entered here, and it opened up here, so that's almost the same, right? The same price. We lost $98. And then the one that I opened on actually on the 15th, which is this candle here, I ended up holding that one overnight. That one should have made some money, you would think. No, not really. This is the range right here. So that one lost money too. Well, let's look at this big one here that's on 5/21. Let's see what happened on that date. Whoa, look at this. 5/21, we got in at 9:30 in the morning and we got out at the end of the day for $877. I think that's the biggest day that I had. So that was a nice one. You can see here that May had some nice big candles, which is where you can make the big bucks. And that's sort of a, a reason why, although I'll get into it more later, but that's a reason why you don't really want to do limit orders on these. You could set your limit at $100 or $80 or whatever you want to set it at, but you're going to miss out on these big ones. And if you're setting a limit at $100 and you have a losing trade and it loses $200, you're going to have a hard time staying above water that way. All right, so let's take a look at, in a little bit more detail, June. June was a losing month. Let me hide these. Bring it over here. Slide it over there. Bring this over. June was a losing month. You can see that we didn't have a lot of ranges on the candles. There we go. We didn't have a lot of ranges on the candles. A lot of reds in here. Probably the best day here was the 18th, which is probably here. No, this one is the 18th. That was the best day. Did we hold on the 8th? 6/8. Let's look to see if we held overnight, because that would have been a good one if we held overnight. No, actually it was good just standing on its own here, because it was $389 on 6/8, and then 6/11. Yeah. So both those days were pretty good days. Can't complain about that, but you can see these hammers and shooting stars and dojis and these things with long wicks and small bodies. These are the ones that hurt. And without going through all the detail for July, you got some really big candles here for the 1, 2, 3 weeks that I was running the test here, and that did pretty good. All right, we're at about 19 minutes into this video, so I think I'm going to stop it for now, and I will pick it up and start doing some things like limit orders and stop limit orders and what kind of impact that may have. And we'll actually go back on using on demand, and we'll go back, and in particular we're going to take a look at 5/9 And we're also going to take a look at 6-4 according to my notes. And 6-4, oops. Yeah. 6-4 is this one right here. So we'll take a look at that one in a little bit more detail so you can get an idea of what would happen if you decide to use limit or stop limit orders. So, thanks for listening. This is again the Daily Straddle Part 3. Happy trading, and we'll see you in Part 4.